All right, welcome back to Truss Talk. I'm Jason Nichols, CMO at Truss Financial Group, a Scotsman's Guide top-ranking non-QM mortgage company. Quick question to you guys. Have you all ever applied for something online? Everything looks smooth, and then suddenly, boom, you get declined? No explanation, no call, just doesn't qualify. Yeah, that's exactly what we're talking about today. Today, we're going to talk about something that confuses a lot of people when they apply for a HELOC, home equity line of credit. Should you go with a fully digital process, or do you need a manual underwrite? Because in most cases, it's not about whether you qualify, it's about whether you're being evaluated the right way.
I'm Jeff Miller, CEO at Truss, and let me say this up front. Most people who get declined for a HELOC are not bad borrowers. They assume that if they get declined, it means something is wrong with their finances. But more often than not, it just means they went through a system that wasn't built for their situation.
Exactly. That's the whole game in 2026. If you look at the market right now, most lenders fall into two categories. You have digital lenders where everything is fast, automated, and very streamlined. And then you have traditional lenders where the process is slower and requires a lot more documentation.
And the second you don't fit perfectly, you're out. No discussion, no adjustment, just next.
Then you go to a traditional bank, and now they want your entire life story, tax returns, statements, explanations. You're sitting there thinking, why is this so hard?
Because both systems are extreme. One is too rigid, the other is too slow, and both of those approaches can work, but only for certain types of borrowers. The challenge is that most people don't fit perfectly into either category.
Let's be fair though, Jeff. Digital HELOCs do work. This is a fully automated process where your income, credit, and property value are verified through digital sources. If everything lines up cleanly, the process moves very quickly. And for the right borrower, this is a great option.
Yep, typically that's someone with strong equity in their home, a solid credit profile, and income that is easy to document, like a consistent W-2 salary.
Yeah, in those cases, there's no reason to slow things down with a traditional review. The system can verify everything efficiently.
But the digital model has limitations. It works best when the borrower's profile is simple and very consistent.
The moment things become slightly more complex, the system can struggle. For example, if someone is self-employed, their tax returns may not fully reflect their actual income because of legitimate business deductions.
From a tax perspective, that's completely normal. But from an automated underwriting perspective, it can look like reduced income.
And the digital system doesn't have the ability to interpret that context. It just evaluates the numbers as they appear.
That's where the hybrid underwriting approach comes in. At Truss Financial Group, we combine a digital front end with a manual underwriting process.
So you still get the efficiency of starting digitally, but there's a human reviewing the file when needed.
And that allows us to look at a much broader set of information. We can review bank statements, profit and loss statements, and other indicators of cash flow. We can also consider factors like reserves, payment history, and overall financial stability, things that don't always show up clearly in an automated system. In practical terms, the hybrid path is often the right fit for borrowers who don't have a completely standard financial profile.
That includes self-employed individuals, business owners, or anyone whose income varies over time.
It can also apply to borrowers with tighter equity positions or credit profiles that are solid but not perfect.
Yeah, in those situations, a manual review can make a meaningful difference in the outcome.
Jason, I think the important thing to understand is that you don't have to decide which path to take. You can just start with a single application. If your profile fits the digital criteria, the process moves quickly in that direction.
And if it doesn't, we transition the file into a manual review without restarting the process.
That way, you're always being evaluated using the approach that makes the most sense for your situation.
Yes, Jeff. This matters because a lot of borrowers are getting declined unnecessarily. It is not because they lack the ability to qualify, but because they're being evaluated through a system that doesn't reflect their financial reality.
And that's especially true today when more people have non-traditional income streams.
The lending process needs to adapt to that reality.
At the end of the day, the goal is simple: to match the borrower with the right underwriting approach.
Because when that alignment is there, the process becomes much more efficient and much more accurate.
If you're considering a HELOC and you're not sure which path applies to you, we're happy to walk you through it. Get in touch with us and our loans officers at Truss.
All right, I think that's a wrap for today. Thanks for listening to Truss Talk. We'll see you next week.